Warren Buffett is not only known to be the greatest investor of these times, but he also sits on the greatest cash pile he ever set. And he is not holding $277 billion at the moment just for fun, but he has some really, really good knowledge on the risk of the market. And the risk of the market could show that Warren is right once again. So stick with me in this video and I will show you exactly what makes Warren Buffett so worried about this market and why we should all, obviously not financial advice, but put some money on the sidelines to invest. So I would do that, but you do you. So stick with me and I will show you, and maybe I convince you to also do the Warren Buffett thing. And before I go with you to the juicy content of this episode, I want to remind you quickly about my channel. I have been doing this on YouTube now for some weeks and months, and I have been committing my time to grow this channel. And so far, we got once 64 likes. So this time it would be my greatest wish if you see that, hit the like button now to make me happy and show the algorithm that this content is relevant. Also, if you haven't seen my last video on the Japanese carry trade, which actually caused this market disorder that we see right now, you can also watch this video and make sure, if you are one of these 95% of people that did not subscribe to my channel yet, go down there and hit the subscribe button and the bell button so you don't miss these episodes in the future. I thank you all so much for watching my content, and let's move right into it. So let's start with the carry trade. While the carry trade has been unwinding, and estimates say that about 200 billion have been unwound so far, there are about 250 trillion yen that have been cross-border loaned by Japanese banks. And these 250 trillion, that's about 1.7 trillion in US dollar. I did the math for you. So this is the current exchange rate that we have, considering that only 200 of these 200 billion of these have been unwound. This is a bit more than 10%. So there is 85% of this money is still waiting on the sidelines to be unwound at one point. And it depends now a bit on how it goes. Does it go fast? Is there any insane cascade happening that creates this to unwind very quickly? Then we will have a massive crash. However, I think what the global financial institutions like the Federal Reserve and the Bank of Japan are trying to do now is they want that this is going down in a very slow process, and therefore the market can kind of it can digest it slowly, so to say. So unwound have been 200 billion. This is analysis from James Malcolm, who is an analyst for UBS in London. And the total, he says, it's at least 500 billion, but we know from the Bank of International Settlements that it might be even more. Important to say here that the detailed exact number is unknown, actually. So there are a lot of estimations. Let's say it's at least 500 million, but probably much more, 1 to 2 trillion. Everything you read about 20 trillion is definitely a magnitude too high, because that's more than the balance sheet of the Bank of Japan. Then we have this Arthur Hayes. I think people know Arthur Hayes if they have been in crypto for a while. He says that conclusion of this was that there was a phone call, and Yellen, so the Treasury from the United States, she called and said, hey, we need Harris to win. You cannot continue that. So the Bank of Japan suddenly said, hey, we won't raise interest rates any further. And therefore, the market kind of became quiet again. So after this strong drop on Monday, we saw that the market was pretty calm yesterday, pretty calm today. Chances are that the carry trade will unwind anyways. And I said that before, there are strategies to make it slow, but it can also go fast. And I have drawn here two scenarios which could lead to a faster unwinding of this carry trade and therefore a further downside for the markets. But don't get me wrong here, the carry trade is not the only thing that is pushing the market down at the moment. There are probably many other economic instabilities, a very fragile global economy that makes it hard. So the first scenario that I'm describing here is that what if Japan doesn't even need to increase the interest rate? And that's interesting because even if the Bank of Japan doesn't do anything, if, for instance, the Federal Reserve, and especially the Federal Reserve, is acting too boldly, if they're cutting interest rates by 0.5% or even more, that could strengthen the yen massively. Because it weakens the dollar when they cut the interest rate, right? And then relatively to the dollar, the yen would become stronger again. So the gap that is between these interest rates of the Bank of Japan and the Federal Reserve would become smaller. Thus, the carry trade would become less profitable, but not for the reason that the Bank of Japan increases it, but for the reason that the American Federal Reserve does it. And if they are too fast with lowering the interest rate, it could happen that the yen becomes very strong again. And then if you watched my last video, you know that it's a problem. Same spiel as last time. Yen gets stronger very fast. That means that it's very risky, and actually those who do the carry trade lose money because they need to give back more dollars worth of yen if the yen becomes stronger. So things with emergency rate cuts and these speculations are not only risky, they're actually pretty stupid at this place. I expect the Fed to, if nothing insane breaks, to lower it only by 0.25%, but obviously I'm not qualified to to know that, neither do other analysts. But if anything is breaking and if it's really going down massively, the Fed could make it even worse if they cut insanely right now. So that's the first scenario. The second scenario is, what if they have no other choice than increasing it again? And that's also an interesting scenario because we know that the Middle East is a barrel that could explode any moment. And if Japan wants to buy these oil barrels that they need for their economy, they need a yen which is not too weak. So the yen cannot be too strong, but also not too weak, because if it's too weak, and this is why the Bank of Japan even raised the interest rate in the first hand, because they needed to stabilize the yen to make it not even weaker, and therefore make it impossible for Japanese companies and Japanese people to buy fuel for their machines, because the industry needs this oil, right? So if the crisis in the Middle East is becoming worse, or if the oil price does increase for any other reason, Japan probably can't do anything else than raise the interest rate at that point. But yeah, these are just two scenarios about the unwinding of the carry trade, let's look at the charts. And that's also something, I don't want to tell you anything special here, that it looks great, because it doesn't. It looks awful. Look at that. So that's the chart of the yen, and not the yen, the chart of the Nikkei. And the Nikkei has been crashing. It was Friday, it was Monday, it massively crashed. And this, what you see here, is not a recovery. This is not a recovery. You see this long red candle here. It started higher, it increased, but it could not grow out this candle. It couldn't even grow it out today. It still closed below the candle from Monday. So this is not a recovery. Also look at the 200. This is the 200-day line. And if you look at that, you see that it's far below its 200 moving average. The Nikkei looks absolutely awful. Then we have the DAX here. Let's look at all of them. The DAX is today, it regained this 200 days average, so it's slightly above it, but still, this is not a strong recovery. This is a dead cat bounce at best. Look at it. I mean, this is not how a bull, like this is not like a bear trap and then we shoot up again. It's not that. Look at the Euro stocks. The Euro stocks is far, far below the 200-day average. It's very, very low. It's also stagnating here and looking to go farther down. The Nasdaq actually lost again today after it started higher. We have the situation where even the American stocks, which have been pulling this market up all the time, are very weak in that way, that they lost their strong trend here. The Nasdaq clearly lost the trend. It's below it now. It's still above the 2-day line, which is kind of optimistic, but it doesn't really recover. Same here. Look at that. I mean, look at this. This is the S&P 500. S&P 500 is not looking any better. It lost its trend. And maybe we go back down to this old trend. That would be a decrease of roughly 18-20%. I mean, it's not even insane. If there is a real crash, that's nothing. It could go even lower than that. So this doesn't look great. This is the Dow Jones. It looks awful. Look at all of these charts. We can look at the cryptos as well. I think Bitcoin isn't looking strong at this point either. Many people were saying like, oh, we go to the moon again. Now we reached 57 and now soon we go higher. This was just a trap, but actually look at it. The charts look awful. But before I go in my rant on the charts, let's look at something different than that, the unemployment rate. And the unemployment rate is a very good indicator also to predict recessions. And this is the American unemployment rate from the United States, which is by far the biggest economy, right? So we see it's doing the same as it did in the crisis 2000, when the dot-com bubble busted at one point, and the recession in 2008, where the unemployment rate also increased massively. So it's this signal here that is now showing strongly that the recession is probably ahead. Why is it that way? Because unemployment means that people have less money. There is less work, which means there is less work to be done by companies. Nobody is buying their things, so they need less employees. Then people get unemployed, so they can buy even less. You see, this is a strong indicator for an economic downturn. And I will show you one more interesting thing. Let's show this instead. This is the 2-year and 10-year yield spread. And the 2-year, 10-year spread is doing similar as the unemployment rate. It's usually predicting an economic downturn. You see it here in the late 2000. It was the whole of 2000. It was basically negative, and it just became positive again shortly before the bubble bursted. And we see the same here. This was 2008. So in 2007, it was negative for a short moment before it rocketed in the economic crisis. The same here. It was never actually as negative as it was right now, or maybe somewhere here in the 80s, but it was so low that it took a long time until it reaches now almost zero. Right now, we are very close to go into positive territory again. And that usually means that the economic crisis is following. So don't be a fool. Don't FOMO into this situation. I can only recommend you to watch these markets closely and have, like Warren, have your cash reserve to buy the dip, and not this dip, buy the real dip. That's what Warren's gonna do. But yeah, I'm not doing your stuff. You decide yourself. I hope you enjoyed this video, and I wish you a wonderful rest of the day. All the best. Your Alex.